Well, as UBS is set to acquire rival Credit Suisse, the US Federal Reserve teams up with central banks to prevent liquidity issues by making sure dollars remain readily available across the global financial system. We're here to discuss the state of the banking system is Lawrence J. White, NYU Stern Professor of Economics. Thank you for joining me this morning, Lawrence. So first, put into context this fall from grace. Of course, this fall from grace for Credit Suisse. This is a very storied bank. Put this into context, into what this actually means for the broader industry.
Well, it's storied, but alas, for the last 10, 15 years, the stories haven't been very good. It's been very poorly managed. And, with a garden variety corporation, a poorly managed company, that's a problem for the shareholders, maybe for the employees. But with a bank, it has larger consequences because banks are so important as part of the financial infrastructure of any economy, and nowadays the financial infrastructure of the global economy. So Credit Suisse, that storied past, the last 10, 15 years, not very good stories.
And we know that what ended up breaking the bank in the end ended up being these rapid net outflows, this concern about this liquidity crisis. But that did seem to be more the issue than looking at what happened with actually Credit Suisse's assets. So why did they need Swiss authorities then to backstop the valuation?
Well, banks are very fragile. Once depositors and other creditors who can pull their money out at short notice, once they start getting nervous, the basic structure of a bank falls apart. We saw that a week and a half ago with Silicon Valley Bank, where the depositors got nervous. On Thursday, a week and a half ago, over $40 billion was pulled out of Silicon Valley Bank. It's not a good thing to have a major financial institution being run on. Again, this is different from your garden variety corporation. Banks are central to the financial structure of an economy, but they are fragile. And so, especially something like Credit Suisse, $500 billion in assets, second largest bank in Switzerland, it gets in trouble, its depositors and other creditors start running, the Swiss government has to do something.
So then what is the cost to the broader banking sector of having to make this rescue, though, for Credit Suisse?
Well, the rest of the banking sector, I'm sure for the last couple of weeks, they've been looking at their exposures to any transactions with Credit Suisse. They're being cautious, and so there's no direct consequence. The indirect consequence is this phenomenon that has been called contagion, that when the creditors of one major bank start getting nervous, when the depositors start pulling their money out, depositors at other banks start getting nervous as well. Banks are complex. Almost all depositors don't have the expertise to figure out, is my bank solid or not? But if they start getting nervous, they start saying, better safe than sorry, and they pull their money out, then yet other depositors start getting nervous, and we have contagion or runs on the bank. Again, a week and a half ago, we saw that with Silicon Valley Bank. The worry was we might be seeing it in the international sphere, not because of any direct connections, but this general contagion problem, nervous depositors, nervous creditors.
And as we look at some of these other distinctions, you note that adequate capital is an issue that European banks face. Talk more about that and what this might potentially mean if you're a US investor looking at what's happening with Credit Suisse and wondering about any connections there.
Right. Capital is the important concept. It's the buffer against losses. It's the difference between the value of the assets and the value of the liabilities. The bigger the buffer, the better a bank can withstand losses, and also the stronger the incentive for the bank not to be taking undue risks because the owners have more to lose. Capital is roughly the equivalent of owner's equity or net worth. If I were an equity investor, I would only want to be investing in solid, well-capitalized banks. Otherwise, I face a significant risk that that bank could exhaust its capital and my investment is gone. If I'm a depositor, I want to be concerned, is there deposit insurance? Am I covered? Are there limits? How quickly do I have access to my money? But being a depositor is different from being an equity investor. But at the end of the day, both categories, you care about the financial stability, financial resilience of any bank or other financial institution that you're doing transactions with.
I'm sure we'll expect a lot more scrutiny of people's banking relationships in the light of all of this. A big thank you there, Lawrence J. White, NYU Stern Professor of Economics.
We're all triply aware now. Absolutely.
Indeed. Thank you for joining me this morning.